Good afternoon, everyone. This is John Swolf at Inside ETFs. We'll be getting started with our ETFs 301 webinar series. In just a moment, we're going to allow those in the queue the opportunity to go ahead and dial in. We'll get started in just about 30 seconds or so. Thank you for your patience. Hello, everyone, and welcome to our Inside ETFs University webinar series. Today is part 3 of our 5-part webinar series. ETFs 301, Be Smart on Smart Beta Equity Factor ETFs Explained. I'm John Swolf, CEO of Inside ETFs, and your host for today's webinar. Before I do turn this webinar over to Chris, I did want to take a minute to thank you, the listener, for joining us, as well as go over a few basic housekeeping items to enhance your webinar experience. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer them live during the webcast, but if a fuller answer is needed or we run out of time, our speakers and sponsors will do their best to follow up. We capture all the questions. I spoke with Chris before this webinar, and he's looking forward to answering your questions, so please go ahead and submit those early and often. We will do our best to try and get to all of those questions. You can expand your slide area by clicking on the maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. If you have any technical difficulty, please click on the help widget. It has a question mark icon and covers most common technical issues. An on-demand version of the webcast will be approximately 24 hours after the conclusion of today's webinar, and that can be accessed using the same audience link you used to log into today's webinar. During the webinar, this is our third installment of our Canadian ETF University series, and we're covering everything from ETF basics to the more complex ETF issues. Today, we're going to take a look at smart beta equity ETFs. The idea of factor investing is not new, but it has really grown in popularity thanks to the ETF wrapper. Factor investing or smart beta ETFs were designed to help investors gain access to strategies that were typically deployed by the most savvy of investors. These innovative ETFs can be used to achieve targeted results like reducing volatility or gaining exposure to things like momentum, value, or size within your investment portfolio. Over the course of this webinar, we're going to explore the ins and outs of smart beta investing with you, and we'll leave you with a core working knowledge and understanding of how to best use these innovative ETFs in your portfolio. I'm truly excited for today's webinar, as I could not think of a better presenter to cover today's topic than Chris Dahl of Invesco ETFs. Chris is the Vice President of ETF Sales and Strategy, a 16-year veteran in the asset management industry, and has held progressively senior roles in product management since joining Invesco Canada in 2010. He manages the firm's Canadian lineup of power shares funds and exchange-traded ETFs. His area of expertise includes smart beta indexing, as well as ETF portfolio implementation, liquidity analysis, and trade execution. He oversaw the launch of various first-to-market smart beta ETF strategies. So as you can see, there's a right to be excited because we could not think of a better person than Chris to lead today's conversation. But with that in mind, Chris, I want to turn it over to you and let you get started. Chris?
Thank you, John, and thank you for that very kind introduction. Good afternoon, everyone. I'm very excited to be here today to talk to you about smart beta and some research that we've done. But just to start things off, during my travels and in the number of meetings that I have every week with advisors and institutional investors, one common question comes to mind. What is smart beta and how do I implement it? And so that's sort of where we're going to spend the bulk of my presentation today. In today's call, I plan to address those specific questions. We'll start by reviewing the goals of the research that we've done here that underlies this presentation. We'll provide clear definition of what smart beta is. We'll review findings from our research we performed on investment factors, and we'll close with some ideas on how to implement these factors into your portfolios to help better meet your clients' investment objectives. The content that we'll be discussing today is based on a white paper that was generated in conjunction with Invesco's Global Investor Forum and is based on research conducted by Invesco ETFs. The Investors Forum brings together each of Invesco's 650-plus investment professionals from around the world to discuss issues that are critical to global investors. Let's start by providing an overview of the research and discuss the goals of the study. Why smart beta? Due to its simplicity, market cap weighted indices have long been a popular means of calculating value of the market in general. But as an investment strategy, market cap weighting has limitations, frequently resulting in outsized proportions of overvalued stocks and less than optimal exposure to undervalued stocks. The one-size-fits-all approach is simple, but limits an investor's ability to target stocks with specific characteristics or investment factors. Smart beta solutions seek to expand investors' options by providing exposure to objective, rules-based methodologies that harvest returns from specific investment factors or deliver broad market exposure through alternative weighting strategies. The goal of the study, we tested two categories of smart beta strategies: investment factors and alternative weighting methodologies, and analyzed how they performed over various market cycles and in various economic environments. We also examined the sensitivity of key economic variables in the form of US dollar values, interest rates, and volatility. Assuming annual portfolio rebalance, we analyzed how smart beta strategies performed during various environments, along with the sensitivity of key economic variables. For the purposes of the study, we use the term smart beta to describe a rules-based methodology that uses factor selection and/or alternative weighting in an effort to outperform a benchmark, reduce portfolio risk, or both. Smart beta strategies are based on the premise that the market prices are not perfectly efficient and that alternative weighting and factor exposure can exploit these inefficiencies. For this study, we tested 5 factors and 5 alternative weighting strategies based on the earliest dates which we could obtain reliable data. Our testing period for U.S. smart beta strategy spans over 25 years, from 1991 to 2006 versus the S&P 500. For international smart beta strategies, the research spans 21 years, from 1995 to 2016 versus the MSCI EAFE index. We also examined smart beta strategies across 5 market cycles, the first which began in 1998. Our goal in this research was to understand what effect these factors and weighting strategies had on performance. Within the study period, we examined 5 distinct full market cycles as shown above. These market cycles cover peak-to-peak and trough-to-trough environments. We use the S&P 500 as a market cap weighted U.S. equity benchmark and the MSCI EAFE index as the market cap weighted international equity benchmark for international developed countries. From this data, we were able to measure the outperformance of smart beta strategies in terms of excess returns, outperformance over the benchmark, downside capture, how smart beta strategies performed in relation to a falling benchmark, and risk-adjusted returns, the amount of risk involved to generate the return. For the study, we selected simple and transparent versions of well-established factors and weighting methodologies that are both widely recognized and commonly implemented. A factor refers to an objective determinant of investment style. While broad market indices do not filter by factors, many smart beta portfolios do. In our study, we selected 5 factors that are commonly used to construct smart beta portfolios. We then segmented the constituents of the market cap weighted S&P 500 index and MSCI EAFE index using these definitions. For quality, we selected the stocks with the highest return on equity. For value, we selected the stocks with the lowest price to book. For small, we selected the smallest market capitalization weighted stocks in the universe. For momentum, we used 12-month price strength. And for low volatility, we selected the lowest volatility stocks as measured by standard deviation over the last 12 months. Stocks within each factor were then equally weighted. On the alternative weighting methodology side, most traditional indices are weighted by market capitalization, the number of shares outstanding multiplied by the share price, which may result in a bias towards overvalued stocks. By contrast, alternative weighting methodologies allocate stocks based on measures apart from market capitalization. In our study, we examined 5 commonly used weighting methodologies. Book value weighted, where we weight constituent companies within an index according to their book values. Total dividend weighted, where we use the total value of dividends paid to determine the weight in the index. Equal weighted, where each constituent gets the same weight. Low volatility weighted, where we weight by the inverse of the stock's volatility. And sales weighted, where we use total revenue to determine weight in the index. Next, I want to spend some time discussing defining what is smart beta. On one side of the investment spectrum, you have passive management, which is basically mirrors a market index, generally seeking to deliver the same return as the index, along with the same level of risk, minus fees. On the other side of the investment landscape, you have active management, which seeks to find non-benchmark opportunities. Active funds seek to do more than simply track or augment market benchmarks. Some pursue high returns, some seek similar returns but with lower volatility, and much more. When pursuing their objectives, active funds may hold stocks that are not in the benchmark, leave stocks that are in the benchmark out, or hold the same companies but with different weights. We use the term truly active to describe funds that are meaningfully different from their benchmark. This is traditionally measured by funds with high active share. Smart beta falls in the middle. It is an alternative index-based selection methodology that falls between active and passive. This management style is based on predetermined rules, is not market cap weighted, but uses alternative weighting methodologies such as equal weight or fundamentally weighted, and can be based on a variety of factors such as volatility or momentum. In addition, smart beta can be active or passive. A passive smart beta tracks a non-market cap weighted index, whereas an active smart beta strategy can include quantitatively enhanced index strategies. Now let's turn our attention to the meat of what the study found. In this section, I will review performance, risk-adjusted returns, and downside capture of the different investment factors and alternative weighting methodologies. Additionally, we will examine the sensitivity of key economic variables in the form of U.S. dollar and U.S. dollar values, interest rates, and volatility. Finally, we will look at the correlation of different factors as a measure of diversification. First, let's start with performance. Among U.S. stocks from December 1991 through December 2016, all 5 factors and all 5 alternative weighting methodologies that we studied deliver excess returns relative to market cap weighted S&P 500 as depicted in the top half of this chart. Among international stocks from June 1995 to December 2016, all 5 factors and 4 of the 5 alternative weighting methodologies outpaced the market cap weighted MSCI EAFE index. Looking at the returns in a different lens, this chart depicts returns by market cycle. It shows that 4 of the 5 market cycles studied, in 4 of 5 market cycles studied, a large majority of the smart beta strategies delivered excess returns over both the S&P 500 and the MSCI EAFE index. Finally, we look at performance. Here we break down the results by strategy and show that every U.S. strategy except for value and book value weighted delivered excess returns over the S&P 500 in more than half the market cycles tested. When compared to the MSCI EAFE index, every international strategy delivered excess returns in more than half the market cycles tested. So, to summarize performance, the factors provided better returns by factor and weighting for both U.S. and international stocks. They provided better returns in different market cycles, and the factors delivered better returns during most market cycles. Now, let's look at risk-adjusted returns. When returns were adjusted for risk, the majority of smart beta strategies continued to outperform market cap weighted exposure during the market cycles. As shown in the chart, all 5 factors and all 5 alternative weighting methodologies had the same or higher risk-adjusted returns than the S&P 500 during the testing period, as seen in the top half of this chart. The bottom half of this chart, during that same time, all 5 factors and 4 of the 5 weighting methodologies generated the same or higher risk-adjusted returns than the MSCI EAFE index. This chart shows when considered by market cycle, in every market cycle except the first, the majority of smart beta strategies generated higher risk-adjusted returns than the S&P 500 index or the MSCI EAFE index. To summarize, risk-adjusted returns provide similar picture to that of performance. Factors generally provide better risk-adjusted returns. Now let's turn our attention to downside capture. Next, we analyze the downside capture to gauge how smart beta factors and alternative weighting methodologies perform during periods of weakness for the S&P 500 and the MSCI indices. Simply put, how much of the market's loss did each strategy realize? As depicted in this chart, we found that most to all U.S. smart beta strategies exhibited lower downside capture ratios than the S&P 500 in 3 of the 5 market cycles. And most to all international smart beta strategies had lower downside capture than the MSCI EAFE index during all of the market cycles. Next, we'll turn our attention to how the strategies did in various economic environments. A strong U.S. dollar tends to attract investments from around the globe, but also makes dollar-denominated goods more expensive in foreign markets. trends in U.S. dollar have also had an impact on factor performance. This chart shows that during strong dollar environments, momentum factors fared the best, while small tilt factors tend to do better in weak dollar regimes. Next, we look at the economic performance in different interest rate environments. The study period coincided with a decline in interest rates to historically low levels as the Federal Reserve attempted to stimulate the economic growth through accommodative monetary policy. The benchmark 10-year Treasury note began the testing period at 6.69% and ended the period at 2.44%, although rates fluctuated within this time frame. As shown in the chart, we found that declining rate environments tended to favor low volatility stocks, while small tilt factor performed well when rates were rising. Finally, we looked at research around different volatility environments. Our research found that low volatility stocks performed best when volatility was increasing, while volatility-oriented and small tilt stocks outperformed when volatility was declining. The chart depicts the factor performance in various volatility environments as measured by the VIX, a measure of near-term volatility expectation. To summarize how the factors did in different economic environments, momentum does well when the dollar is strong. Small cap does well when the dollar is weak. Declining rates lead to strong low vol performance, while rising rates benefit small stocks. Low vol does well when volatility is rising, and value and small do well when volatility is declining. Finally, let's take a look at the correlation and the potential diversification benefits. This chart illustrates the diversification potential of factor investing by depicting the correlation of smart beta factors to each other during the testing period. One reflects perfect correlation and -1 reflects perfect negative correlation, while 0 reflects no correlation. Low levels of correlation indicate one factor outperformed or underperformed the S&P 500 at different times than another factor. Generally, correlation between 0.5 and -0.5 have historically led to diversification benefits when adding to portfolios. Note the relative low level of correlation between most factors studied, providing a potential diversification benefit. To summarize the table, small and momentum stocks add benefits to quality portfolio. Momentum and low volatility stocks add diversification benefits to a value portfolio. Quality, momentum, and low vol stocks add diversification to a small cap portfolio. Value, small, and momentum add diversification benefits to a low vol portfolio. The one interesting thing to note here on this slide, though, is you get strong diversification benefits from all factors against a momentum portfolio. So, to conclude the discussion, we believe that smart beta strategies offer a stronger investment foundation than market cap weighting by providing exposure to specific investment factors that may result in outperformance and help to eliminate the shortcomings of market cap weighting by breaking the link between a stock's price and its weight in the portfolio through alternative weighting methodologies. The wide variety of opinions may be daunting for some investors. we would urge investors to consider these 3 points: diversification, market cycles, and the cost of executing smart beta strategies. From a diversification standpoint, various factors and methodologies perform differently across market and economic environments, as we've seen in this research. While each strategy experienced periods of underperformance, it's important to note that each strategy's greatest degree and length of underperformance versus the S&P 500 or the MSCI EAFE indices occurred at different times. In addition, each strategy provided varying results across different market environments. For these reasons, we believe diversification across strategies may help mitigate the overall effect of underperformance on a portfolio. Market cycles. Commonly, investment performance is examined on a trailing basis, such as 1, 3, or 5 years. However, we believe full market cycles provide the proper context in which to evaluate long-term performance as opposed to a snapshot in time. This is because full market cycles capture all the ups and downs and inflection points that affect overall performance. Snapshots in time may only reflect one particular market environment rather than a truly comprehensive view. In short, individuals typically don't invest in 1, 3, and 5-year increments, so we believe the market cycle view is a better represents the typical investor experience. When considered over full market cycles, smart beta strategies have exhibited strong, absolute, and risk-adjusted performance, as this research indicates. Finally, the cost of executing smart beta strategies. While smart beta strategies can be accessed through a variety of investment vehicles, including mutual funds, ETFs are the primary vehicle through which smart beta strategies are implemented. ETFs are designed to track underlying financial indices, and there are costs involved with the tracking process. Our analysis did not include implementation or management costs. Had the cost been included, results may have varied. Though results may have varied, we do not believe the inclusion of these costs would have materially affected the results. The results of our study show that smart beta strategies displayed a clear pattern of outperformance relative to market cap weighted S&P 500 and MSCI indices over 2 decades, a period that includes 5 different market cycles and other forms of market uncertainty. While conventional wisdom dictates higher returns generally come with added risk, the majority of smart beta strategies we studied outperformed their market cap weighted benchmark even when adjusting for risk. This is meaningful for investors who use smart beta strategies in their core portfolios with the goal of generating excess returns. Investors should take into account their own considerations before investing in any strategy. We encourage you to talk to your Invesco wholesaler about the ideal exposure to any single methodology and discuss the optimal way to combine various factors in order to pursue your investment objectives across market cycles. Thank you, and I think we'll turn it back to John and open it up for questions.
Yeah, Chris, thank you very much for that. And again, I would encourage the audience to submit their questions, and we'll get to them. Chris, one of the questions that I always hear when I speak with advisors is they're just not sure how to start this conversation with their clients, right? They've typically talked about diversification and market cap exposure and those things, and it can be a little daunting to try and bring up the subject of smart beta and factor investing. How have you guys found the successful advisors, as you said, who use them in their core portfolio, approach that conversation with clients and help them understand how these products work?
Yeah, John, that's a great question and one that we get on a regular basis. I think the best way to approach the discussion of how to implement or integrate smart beta into a conversation with your clients really stems from an understanding of what the client's investment objectives are. What are they trying to solve for? Are they saving for a specific event? Are they worried about a smooth ride to retirement or through retirement? Do they have some need for income? These types of outcomes will help dictate which investment factor is most appropriate for the client in meeting their investment objectives. And once you've identified that, it's real easy to draw a parallel to the factor that will meet their needs and how the investor understands that factor.
Absolutely. I think you're spot on with that, and I appreciate the answer there, right? It does start with that conversation of identifying what are they trying to do with their money, and then finding the best factor to go ahead and kind of help them achieve that outcome. So, Chris, I know that was just kind of from the last takeaway that you had there on your slide, but I want to go back a little bit to kind of the beginning here and just kind of drive home that point of where smart beta really differs from cap-weighted indexes, kind of what actually sets it apart. When you start thinking about it from a cap-weighted perspective, how is the smart beta, index or approach different?
Yeah, so for that, I think we look at it in a number of different ways, and I'll take us back to the slide where we had the three types of factors, or three types of investment management techniques across the universe. So, if you think of where we've come from, you have traditional passive investors who want to track an index, and typically that's been a market cap weighted index. And they're fine to take the ups and the downs as long as they get the returns of the index less some fee. On the other side of the spectrum, we have active investors, those that believe that investing in a portfolio of unique stocks that differ from the benchmark will add value over time. And from the research that we've found, investors, portfolio managers that do buy concentrated portfolios of unique stocks that look different from the benchmark have historically added value over time. That's why we talk about active share and looking at a portfolio that has high active share as an indication, a simple indication of the portfolio manager's ability to add value over time. And then smart beta blends the two together. And so all you do is you're taking the best of the economic factors that have been invested over time on the active side and putting it into a transparent, rules-based methodology like we have on the passive side and calling it smart beta. And again, you can get that in one of two ways. You can do it index-based, purely passive, or you can do it quantitatively based, and it's sort of a transparent methodology that the manager operates, but all rules-based driven.
Great. And that's an important distinction, I think, when you start to talk about rules-based versus active, right? An active manager can, if they want, pick and choose stocks based on how they feel that day or whatever methodology they want to use. With smart beta, that rules-based approach is keeping you in line to where you kind of blend those two, as you said. But is the rules approach the same for every factor, I guess is my question for you.
No, the rule sets will vary from factor to factor. So, for example, on a low vol factor, you might screen by selecting the lowest volatile stocks, and that may be the driver of the performance of that indice. On the flip side, you may look at something that selects that uses the broader index, but weights stocks slightly differently, like an equal weight, and where the driver of the returns in that strategy might tilt towards small or value type factors than the market cap weighted index. So each methodology has its own unique construct, and the merits of the index methodology will dictate whether or not there's value to be added from the strategy.
Right. And then my follow-up question for you on that was, that those rules that you put in place at Invesco ETFs, are they going to be the same rules that other issuers are going to use if they want to identify value or what they might use for momentum or low vol, those types of things? Is that standard across the industry, or are there different ways to look at the factors and create your rules?
Yeah, good question. I think it depends on what the strategy is tracking. If the strategy is tracking a widely recognized smart beta benchmark, and two ETF product providers are issuing products on that same benchmark, then there will be no difference. If the strategy is quantitatively driven or some internal methodology that's been developed, then yes, that will likely differ than other strategies out there. We've taken the approach of partnering with S&P for a lot of our smart beta strategies, and so we have strong relationship with them, and we generally are the only provider of the S&P 500 Low Vol Index or the S&P 500 Quality, Value, and Momentum Index in the marketplace. So from that standpoint, they're different from the MSCI factor index that's offered by a competitor manufacturer.
Right, and it goes back to the point of having to do your homework and do your due diligence on your ETFs to make sure you know what you own. Right, the nice thing about an ETF is they are transparent, so you're able to look through and see that. Chris, one of the things that you typically hear a lot about when it comes. Oh, go ahead, Chris.
Yeah, just on that, that's a very important point, and I think that a lot of investors get overwhelmed by the proliferation of indices and products that track those indices. If there was one takeaway from the call today, it's do your homework. Take 10 minutes before investing in a smart beta strategy and read the index methodology. Generally, it's pretty clear, it's easy to follow, but what you're looking for are what is the selection criteria, what is the starting universe, what is the weighting mechanism, and what are the rebalance frequencies. And those sort of four key variables will determine whether or not the strategy will add value over time. If you have a starting universe that is consistent with what you want to invest in, if you have a selection criteria that is consistent with the investment objective you're trying to achieve, if you have a weighting mechanism that also adds a layer of protection or risk mitigation, and then finally, if you have a rebalancing frequency that's not so frequent to drive up trading costs and wipe away any added value of that smart beta strategy. So that's a very important point, I think, John, that it'd be good for investors to take away from the call today.
Yeah, and Chris, I have to say, in all the time I've been dealing with smart beta, I've never heard anyone lay out those four criteria for starting due diligence on smart beta. That was fantastic. That really helps me personally understand better how to look at these ETFs now. So I appreciate you sharing that. But the question I wanted to get to along these lines is one of the things that you always hear from maybe, say, active managers or the truly passive investors out there is that these smart beta strategies, they're all based in research and they're cherry-picked. You've shown in your study today that they do perform in real life. But with that, do you have to own those factors for 20 years? Do you just have to own them at the right time? How do you kind of take what's so great about smart beta from the academic standpoint and make sure you get those same benefits in the real world when you're investing?
So a couple of points there. I think that, yes, we do hear that often, that the instant rebuttal to factor or smart beta investing is, oh, it's a new fad, and, this is just back tested, and, there's no sort of, there's nothing foundational about what we're offering here. I would say that's not the case at all. The biggest evolution in this is we've only taken these strategies that have been tested out in academia, built into practice in different portfolios, traditionally active managers or institutional investors, and distilled them down into a very simple, transparent methodology that investors can now access. So while many investors didn't necessarily understand what the portfolio manager was doing in their portfolio, they're typically tilting towards buying lower volatility stocks, buying higher yielding stocks, buying value stocks or quality stocks. So I think that's a misconception in the marketplace, that there's nothing substantial behind this. And the other thing I would say to that is, a number of the strategies that we have had in market do have a long track record. So we have been around, Invesco ETFs and the PowerShares brand has been around since 2002, and we set out at the outset to bring to market strategies that offered something different than a market cap weighted indices. So fast forward 16, 17 years, and a number of our strategies have 10, 12, 15-year track records on them. So you can see the live environment and how these strategies perform in different market environments with real data. It's not academic, it's not index-based or research. Sorry, John, there was a second part of your question that was important that I wanted to get to. What was the second half?
So I was saying then that, yeah, so it was more along the lines then, I think, maybe of the holding period. Do you have to hold these smart beta ETFs through the full kind of 20 years, or do you just have to own them at the right time? It was kind of, how do you get the real life benefits of them in your portfolio?
Yeah, I think there's a couple of different perspectives on that. There's certainly some advisors and some market strategists who believe you can rotate through the factors as we evolve through different market environments. Obviously, you're going to drive up your trading costs. You're going to generate more tax liabilities potentially if you do it well. And so that's sort of one approach. And so you could time the market if you had sophisticated enough models to do so. We don't necessarily advocate for that model. I think the benefit of these strategies is tying them to an investor's investment objective, and then buying and holding it for the longer term. As illustrated in the correlation table that we talked about earlier, there's a lot of benefits of pairing a few of these factors together. So if you wanted to add a little growth to your portfolio, but take some risk off of the portfolio all at the same time, pair momentum and low vol, for example. If you like quality and small cap, pair those two together. So there's different ways that you can go about building portfolios to help meet an outcome or an objective that an investor has. But from my perspective, buying and holding these strategies for the long term does make the most sense. It's not imperative to capturing the value the premia that these factors provide, but it is a more consistent strategy over the long term. Now, having said that, there will be periods where you will do very well, and there will be periods where you underperform. That I'm not claiming that these strategies have consistently performed over time. What I am let me rephrase that. I'm not claiming that these strategies are perfect in all markets. What I am claiming is you will do well in the long run, and generally they outperform anywhere from 60% on rolling 3-year in the U.S. and about 70% on rolling 3-year returns for international. So there is a consistency to them, but there will be periods where you will underperform the market. Again, though, if you're positioning this with your clients as something to help meet their investment objectives, you're coming back to, is the strategy still meeting the goals that we laid out for you at the outset? And that should generally be the case throughout any market environment.
Absolutely, and I think that's great to highlight there, that it has to tie back to what your investment objective is, not what you see going on in the market, maybe over the course of a month or 3 months or 2 years. It really is, if you said that, kind of smoother ride to retirement or whatever it may be. That's what you got to keep in mind as you go through it. So appreciate you taking the time to go through that. Chris, actually, we got a question that wants to go back to what we were talking about before, about your kind of 4 criteria when you start to do your due diligence on smart beta. And they want to know why is the starting point important once an ETF is up and running? So I guess they want to know, why does it matter what the universe is that they select from if the ETF is up and running and has a track record?
Yeah, starting point is important because it helps you build a diversified portfolio to meet your needs, right? So if you wanted to build, you could build diversification in a number of different ways, right? So you could have a geographically diverse portfolio where you've got Canada, US, Europe, maybe emerging markets, Asia Pac, and then you overlay that with factor diversification, which we saw earlier. So the starting point is relevant from the standpoint of which country or region are you trying to add to your client's portfolio to build out a more robust or more diversified exposure for your clients. And so that's why the starting universe, from my perspective, is important. You need to know what it is you're going to be buying into, because you could buy the Wilshire 5000, and you've got the smallest company in the United States in your index, but it doesn't add a lot of value, right? So that starting universe is important from a diversification standpoint. It's important from liquidity and execution standpoint in being able to get into or out of the strategy. A number of different layers there on why that starting universe is important to assess when valuing. The other way you can also look at it is going up or down the market cap spectrum, right? So if you're going diversification by region, and then by factor, and then by market size, so if you want a small cap tilt instead of a large cap tilt for your U.S. equities, you could look at it in that way too. So instead of looking at the S&P 500 as your starting universe, maybe you're looking at the S&P 400 mid cap or 600 small cap as your starting universe.
Yeah, I appreciate it, and that makes a lot of sense. That you certainly want to, as you build out your portfolio, you want to know where you're starting from. Chris, one of the things that we come across in our time of running our conferences and running events and webinars focused on smart beta is the idea of core versus tilt. And I want to ask the question from the standpoint, if I have a portfolio already built and I'm using cap-weighted indexes, ETFs, and taking that kind of passive approach, can I use smart beta or factor ETFs to enhance that portfolio, or do I have to use these as my core building blocks?
No, you can totally maintain your core portfolio and add smart beta strategies in to tilt one way or the other. A classic example of this is the current market environment that we're in. We've seen a lot of increased volatility in the last month and a half, 2 months. If you're holding a market cap weighted portfolio, you're being bounced around with that volatility. With the good comes the bad, right? But if you wanted to take some risk off that portfolio but not sell out of your core market cap weighted strategy entirely, you could augment that with a low volatility strategy, maintain your exposure to the equity markets, but take some of the risk off the table. And we've seen that has added value. You're reducing your risk of your portfolio overall. You're picking up a little bit of excess return because low vol has added value over time, as we saw in this strategy here. And so it's still core, but you can tilt to different strategies in different market environments. So on the flip side, when coming out of the financial crisis 10 years ago, you would have done really well to buy a momentum strategy to pair with your S&P 500 in March of 2009. You would have performed quite well coming out of that. So again, depending on the economic environment and where we are in the market cycle, you can certainly use factor tilts to enhance your core passive strategy.
Thank you, and that's great. And I think that's something that people or advisors are starting to come around to now, is that it doesn't have to be one or the other, and they can be useful tools to tweak portfolios and do different things here and there. So, Chris, we have time for about one more question, and this is one that we get all the time when we do these things, is the single factor versus multi-factor. And I think it's a two-part question. Is one, can I just go buy a multi-factor ETF and just kind of set it and forget it? Or do I have to, if I'm going to use multi-factors, do I have to do it myself and make sure that I'm kind of not necessarily timing the market, but I'm using the right factors together at the right time?
So both options are viable options. So you can, there are product providers out there that do offer multi-factor strategies. We have some strategies that include 2 factors in them. So for example, our RAFI strategy, tilt, value, and small cap. Other providers include more factors. So there are tools, products out there to help investors get exposure to multi-factors like that. On the flip side, to your question, do I have to do it myself? You can certainly do it yourself. If you paired all 5 of these factors together in a passive equal weight exposure and rebalance it on an annual basis, not having to worry about timing at all, you will add value and likely beat the market over the long run. So it's not a complicated thing to build a portfolio of single factor strategies. You can certainly use that correlation table that we included earlier to select a couple of factors that have exhibited low correlations to each other. So you're pairing your trade when one is in favor, it's offset by another one that maybe is not. So you could do it in a couple of different ways to help achieve your objectives.
Great. And Chris, I want to thank you for your time. We are over our 50-minute mark here, so I do appreciate you taking the time to put that study together and share that with us. I want to thank the listener for joining in today. Remember, if you want to get a copy of today's webinar, you want to listen to a replay, you will receive an email within 24 to 48 hours of the conclusion of today's webinar that will have the slides in it and everything like that. I want to remind everybody to join us again the same time next Thursday as we take a look at fixed income factor ETFs. That's our ETF University 401. So it's fixed income factor ETFs. That's at 2 p.m. next Thursday. And I'd also like to remind everybody, if you like what you've heard on today's webinar and want to learn more about smart beta or more about ETFs, you can join us on June 21st and 22nd in Montreal for the first annual Inside ETFs Canada conference, where we'll be tackling all types of issues related to ETFs, from things like today's topic of smart beta to liquidity to the basics of ETFs. So again, that's in Montreal, June 21st and 22nd, and you can register at www.insideetfscanada.com. Again, that's www.insideetfscanada.com. Again, thank you to everyone who joined us. We appreciate you taking the time out of your busy day to be here. From all of us at Inside ETFs, thank you and have a great day.